Morning, students. Welcome back to this discussion on consolidation. So, in the previous session, we started discussing about AS21. That was more in the nature of the consolidation requirements in relation to the subsidiaries. So, today we plan to continue on that, and we'll also try to touch upon certain more aspects in relation to the consolidated financial statements, which is something beyond about these subsidiaries, wherein we'll just try to look at associates as well. Okay, so coming back to the discussion that we have had so far, let's do a quick recap in terms of what all things we have covered. So let me just share this presentation with you first. All right, so as around the consolidation, the important part that we discussed was the group. Okay, so now in relation to the group, we discussed that the approach which is required to be considered is the one wherein this group is considered as if it's a one entity while preparing the consolidated financial statements. Okay, and can you tell me what does this group comprise of? So in terms of consolidation, when you talk about group, what do you mean by group? What does that group comprise of? Over to you quickly. Yes, what does that group comprise of? Which is required to be consolidated. So, which all entities will form part of that group, wherein the consolidated financial statements will be required to be prepared. Yes, quickly, everyone. So, which all entities you think will form part of the group, which will be required to prepare consolidated financial statements? Yes, quickly, waiting for your response. Yes. Okay, great. So Swati is saying one is the holding company. What about other entities? What do you call those other entities as? So one, of course, is the holding company. So holding company happens to be the company which will be required to prepare the consolidated financial statements. But other than holding company, there will also be a subsidiary which will get included in that consolidated financial statements. Okay. Now, as far as consolidation is concerned, we discussed that this is something which comes from the requirements from the Companies Act, wherein the companies are required to do this consolidation. And once this consolidation becomes applicable, that is when we move on to AS21, because AS21 will give you the guidance, will give you the steps, all the requirements in relation to preparation of the consolidated financial statements. Okay. Now, in relation to some of those steps, we discussed certain aspects. Okay, so we talked about minority. So can you quickly tell me what is minority? What is the meaning of minority? What do you understand by minority? Quickly, what do you understand by minority? So in the previous session, we talked about minority interest. Okay, we also discussed what do you mean by minority? Where is this minority required to be considered? What is the basis of computation of that minority interest? Yes, if you can just help me understand, what do you mean by that minority interest, which is required to be considered? Quickly. Okay, great. So Swati is saying, if in case there are some shares which are not held by the holding company, okay, so something which you call as the remaining shares. Okay, remaining shares means other than what the holding company is holding. Okay, so all those entities, or if there is only one entity which is holding those shares other than the majority shareholder, that is what you call as minority. Correct? Now, in relation to minority, we discussed that this minority interest will also be required to be computed whenever consolidated financial statements are required to be prepared. Over and above that, we also discussed that at the time of consolidation, there are a couple of things which are required to be done. One, you will have to look at the purchase consideration. Means when you acquire an entity, what is the purchase consideration which has been paid, and whether that purchase consideration is in excess or is shorter than the net assets of the subsidiaries which have been acquired. Okay, so if let's suppose purchase consideration is in excess, so can you tell me what is the impact? If purchase consideration is paid in excess, then what is the impact? What do you get if the purchase consideration is in excess? Great. So Swati is saying therein you will get goodwill. And if let's suppose that is lower than the net assets acquired, then what will you get? Yeah, Manish, if let's suppose that is lower, then what will you get? Great. So Swati is saying it will be capital reserve. Yeah, same is the response from Manish. Very good. All right. Other than that, we also discussed that whenever you will be looking at the consolidation, in some cases, these net assets of the subsidiary may not be acquired at the book value. Okay, it may be agreed between the two parties that the net assets or some of the assets of the subsidiaries will be taken up at agreed values, or which you call as revalued amount. Okay, in such a case, what will you do? You will not be adjusting all those agreed values or those revalued amounts in the standalone financial statements of either the holding or the subsidiary. Why? Because therein you will not make all of these adjustments. So can you tell me where do you make all of these adjustments, if at all there is any revaluation, if at all any revalued amounts are required to be considered in respect of net assets of the subsidiary? Quickly. So where do you make all of these adjustments? Where will that impact go? Yes, over to you. Where do you make all of those adjustments, if at all there's any revaluation of any assets of the subsidiary at the time of acquisition? Tell me quickly, huh? Where do you take the impact? Where do you make all of those adjustments? Great. So Swati says it will go to the financial statements to be prepared by the holding company, which is nothing but the consolidated financial statements. Okay. When you say holding company financial statements, it may also mean standalone financial statements of holding company. Okay, which is not appropriate. So you'll have to consider only the consolidated financial statements. Why? Because this adjustment will go sit in the consolidated financial statements only. Yeah, otherwise there will not be any impact on this. Okay. Now, moving further on this, now we'll talk about some more adjustments which are required to be considered at the time of consolidation. Now, when the consolidation is required to be performed, in such a case, what you will be required to do is you will be required to look into the acquisition date. Okay, so let's suppose this is the acquisition date. Yeah, and say this is 28th of November 2024. So this happens to be the acquisition date. Now, because this acquisition date is falling anywhere during the financial year, okay, so it's not something which is there on 1st of April or 31st of March. So it falls on any day during the financial year, and that's how acquisition will also be done. Yes or no? So the profits which are prior to the acquisition date of the subsidiary, what do you call them as? Pre-acquisition profits. Okay. Similarly, the reserves which are there at the time of acquisition in relation to the subsidiary, what do you call them as? Pre-acquisition reserves. Okay. And after the acquisition, because this subsidiary company will continue, so it will keep making profits or the losses. Yeah. So what will you term those profits or losses as, or about the reserves which are going to be built up post acquisition? Okay. So these are the terminology you are required to use. Post acquisition profits or reserves. Okay. Now, in relation to this split or segregation, there are some adjustments which are required to be considered at the time of consolidation. Okay, so that's why it's important to understand as to what is there prior to acquisition and what is there after the acquisition, which we term as pre-acquisition or post-acquisition. Similarly, we may call it as capital profits, means prior to acquisition, or revenue profits, which is post acquisition. Okay, so we can say that against this, we can also use the term capital profits. And against this, we can use the term revenue profits. Okay. Now, sometimes you may also find that there are some dividend distribution. Okay. Now, who will distribute dividend? That will, of course, be distributed by the subsidiary to the parent. Yeah, subsidiary to the holding company. Now, in relation to that dividend distribution, certain adjustments are required to be considered. Now, if you look at the dividend which the subsidiary will pay to the parent, what will happen? Parent should record that as income. Yes or no? Parent should record that as income. Now, if at all that dividend is paid out of post acquisition profits, so that is something you'll have to evaluate. Okay, then what will the parent do? Parent will record that as income. Okay, so parent will record that as income. So that will be recorded in the P&L of the parent. Okay, so I'm talking about the dividend which is distributed or paid out of post acquisition profits. Okay, now for getting into this assessment, what do you need? You need this first step. Okay, this cutoff first of all, and the split of the profits or the reserves. Clear? But if let's suppose subsidiary pays the dividend, but that dividend is paid out of pre-acquisition profits, okay, then what will happen? Then the accounting treatment will be different. Then it will not be taken to the P&L. Then it will be adjusted against the cost of investment, because holding would have invested in the subsidiary. So you can say in a way that cost of investment will be reduced. Okay, so that's how it's required to be considered by the holding company in relation to the dividends which are distributed by the subsidiary company to the parent company. Yeah. Now, in relation to this, what we can do is we can just look at some adjustments. Okay, and we can look at some examples, I think, to get better understanding around this. Okay, so let me just take you to those examples now. Just a minute. So let me just move on to that example. All right, so you can go to page number 10.37 if you want to refer the study material. Otherwise, you can also refer it over here. Okay. Now, in this illustration, XYZ purchased 80% shares of ABC on 1st of January 2000 X1. Yeah. And for doing this, 1,40,000 was agreed. So this was the amount agreed. Okay. Issued capital of ABC Limited on 1st of January 2000 X1 was 1 lakh, and the balance in P&L was 60,000. Okay, so that's the cutoff, 1st of January, when the acquisition has taken place. On that particular date, we are looking at the financial information of the subsidiary which has been acquired. Now, in relation to this, important part to understand will be the balance of profit and loss, which is nothing but a kind of reserve. Okay. During the year ended, now we are looking at the calendar year. During the year ended 31st December 2000 X1, ABC Limited earned a profit of 20,000 and at the year end declared and paid a dividend of 15,000. Okay. Show by an entry how the dividend should be recorded in the books of XYZ Limited. Now, we are just required to pass an accounting entry to show this accounting treatment in the books of the parent. XYZ is the parent. Further, it says, what is the amount of minority interest as on 1st of January 2000 X1 and 31st December 2000 X1? Because the amount of minority is also required to be computed on the date of acquisition and as at the reporting date. Reporting date in our example is 31st of December 2000 X1. Also, please check whether there should be any goodwill or capital reserve on the date of acquisition. Okay, so now in this example, if you look at, three things are required to be computed. One, of course, is about the goodwill or capital reserve, which is going to be there in most of the questions. Then the second thing will be about the minority interest, which is again sort of required to be done when you look at the adjustments on the acquisition date. And third is the adjustment in relation to the dividend which is paid by the subsidiary to the parent. All right, so let's look at this. So now in this case, if you look at the dividend, it's 15,000, and because this has been paid at the end of the year, 31st December 2000 X1. Okay, so what do you assume? Okay, it will be more appropriate to assume that this has been paid out of the profits of the year. So during the year, amount of profit was what? 20,000. 20,000. So that means out of this 20,000, a dividend of 15,000 has been paid. Okay, which means that the dividend has been paid out of the post-acquisition profits. In which case, what will be the adjustment entry on the part of the holding company? Holding company will take it to the P&L. So it will be recorded in the P&L of the holding company. It will not be adjusted to the cost of investment, unlike what we do in case of pre-acquisition part. Yeah. So 15,000 is the amount. Hence, this will be taken to the P&L of XYZ. XYZ is the holding company. Now, 15,000 is the total amount of dividend. So can you say that this total amount of dividend pertains to the holding company? Completely no. Why? Because this dividend is declared and paid. This is the total amount of dividend. So 80% part of this will go to the parent. Why? Because parent holds only 80%. Okay, so that's why what is going to be the amount of dividend? What is going to be the amount of dividend for the holding company? It will be 12,000. It will be 12,000. Okay, so let's look at the accounting entry. So for the parent, accounting entry will be very simple. They will receive money. So bank debit to profit and loss account, which is nothing but the dividend income 12,000. Now, let's try to compute the goodwill or the capital reserve. We don't know whether it will be goodwill or capital reserve. So we'll have to just understand. Now, in this case, purchase consideration was 1,40,000. Because that's the amount paid to acquire the shares of subsidiary equivalent to 80%. So 1,40,000 has been paid. Now, against this 1,40,000, what do we need? Net assets of the subsidiary. Now, in relation to the net assets of the subsidiary, if we look at, so capital was 1 lakh and profit was 60,000. Okay, so these were the total net assets. So 80% of the amount is what the parent has acquired. So 80,000 against the capital, 48,000 against the P&L balance on the date of acquisition. So that is what you will consider. So this gives us a total of 1,28,000. So now purchase consideration is paid in excess of net assets acquired. Okay, therefore the amount of goodwill that we get is 12,000. Yeah, because it's in excess. So that's why what do you get? You will get the goodwill. In this case, you will get a goodwill. Correct? Now, in relation to minority, if you look at the minority interest, minority is required to be computed on two dates. One, on the acquisition date. Now, on the acquisition date, can you tell me what is the amount of total net assets? Quickly, over to you. What is the amount of total net assets on the acquisition date? Yes, quickly, everyone. Tell me, on the acquisition date, what is the amount of total net assets? Yes, waiting for a response. Great. Malu is saying 1,60,000. Now, when you compute minority, what do you pick up? You pick up the proportionate share of the net assets. Okay. Now, If you are required to compute the minority interest on the date of acquisition, wherein you understand that net assets are 1,60,000, so what will you do? You will pick up the share proportionately. So it means that on the acquisition date, the amount of minority interest will be proportionate to the net assets. So can you tell me the amount of minority interest that you will have on the acquisition date? Yes, quickly. On the acquisition date, what is going to be the amount of minority? Yes, waiting for a response. Quickly, yeah? Everyone, it's very simple. So tell me, what will be the amount of minority that you will get on the acquisition date? Okay, great. Swati has computed. So Malu has also got this 32,000. Great. So it will be 1,60,000 into 20%. Yes or no? 1,60,000 into 20%. Yeah. So that is going to be the amount of minority on the acquisition date. Yes. Okay. Now, as we move further, when we reach the reporting year. Now, on the reporting year, at the reporting date, means as at 31st December, if we are required to again compute this minority interest, again the procedure will be same. So the procedure will be no different. Yeah. So what does it mean? Here again, we'll have to compute the amount of net assets first, and the proportionate amount of net assets is something which will go to the minority interest. Okay. Now, in this case, at the year end, we don't have the balance sheet. Okay. But the opening balances, we can just move forward and make the adjustments on the basis of the information which is available in the question. So opening balance was 1,60,000. I'm talking about total net assets. Out of this, what do you do? Out of this, a dividend adjustment is required to, or in relation to this, a dividend adjustment is required to be considered. Now, during the year, when you look at the reserves, okay, so now in relation to the reserves, the profits have increased. So 20,000 is the amount of profit by which this reserve will increase, or the net assets will increase. So 1,60,000 will get increased by 20,000 because of the profits. But out of these profits, 15,000 has been paid out. Okay. So those reserves have been shared with the investors, whether that investor is majority shareholder or minority shareholder. So that's why what is going to be the closing balance of net assets? 1,65,000. Now, when you are required to compute the minority, what will you do? You will pick up the proportionate amount. So that will be 33,000. Okay. So 33,000 will be the amount of minority interest as at the reporting date. Okay. Yeah. Simple, easy one. Any questions if you have so far? Okay. Swati is asking, sir, MI are also getting dividend of 3,000. So why we are not adding it? See, MI is a shareholder, first of all. Please consider that. Now, MI is getting a dividend of 3,000. You are right. But that dividend which MI is getting so MI is getting that on a standalone basis. Okay. So MI as an investor is getting that. But currently this minority interest is in relation to that part of the minority which will go and sit in the consolidated financial statements, which is not yet distributed to MI. So in the consolidated financial statements, when you prepare it, so let me just go to one working file. Okay, so when you prepare your CFS, so what do you do? In the CFS, you will present one line item as minority interest. Okay, let's suppose that amount is 33,000. Now, what does it indicate? It indicates that minority has got an amount equivalent to 33,000. Okay. So in the group's financial statements, there is an amount equivalent to 33,000 which belongs to the minority. Means this much portion of the net assets belongs to the minority. If you will say that out of 33,000, if let's suppose we say out of 33,000, 10,000 is now paid to minority. So will that remain outstanding in the consolidated financial statements? The answer is no. Answer is no. Okay. Now, if we look at the total reserves, so the total reserves were 1,60,000. Total reserves, I mean to say capital plus the reserves. So net assets. So they were 1,60,000. Okay. Now during the year, if you look at the company produced profits equivalent to 20,000. So thereby the net assets, if you look at the end of the year, what has happened? They have increased to 1,80,000. Now, this is the amount of net assets as at the year end. So this was 1st January X1. This is 31st December 2000 X1. So if let's suppose there was no distribution of dividend, then the amount of minority interest would have been a proportion of 1,80,000. Yes or no? Tell me. So if no dividend would have been distributed, then the amount of minority interest would have been a proportion of this 1,80,000. Yes or no? So can you tell me the amount that you will get? So if you compute it, what will be the amount of minority? Quickly, everyone, huh? So what will be the amount of minority if you don't distribute dividend? Okay, great. So Swati is saying it will be 36,000. So now if you pick up the minority, which is 20%, so it will come out to be 36,000. Okay. Now, if let's suppose there was no distribution of dividend, so you would have presented minority in the consolidated financial statement as 36,000. So which means you would have said in the consolidated financial statements that 36,000 is the amount that belongs to minority. Okay. So whenever this much reserve will have to be paid out, so this much amount will go to the minority. Means this is the portion which belongs to minority. But if let's suppose out of 36,000, you pay 3,000 to the minority. Let's suppose 3,000 is paid to the minority. So will you continue to say that 36,000 is the amount which belongs to the minority? Tell me, will you continue to say that? If let's suppose out of 36, you pay 3,000 to them. So what will you do? You will say, no, now the amount of minority is reduced. Yes or no? You will say amount of minority is now reduced. So which means 33,000 is the amount which will then remain outstanding. So we are talking about the outstanding balance in relation to the minority. Without dividend distribution, this would have been 36,000. But after dividend distribution, it's not 36,000. It will get reduced. Understood? Swati, clear on this now? Yeah, clear on this? Okay, great. All right. So what we can do is we can just look at one more example in relation to this. Okay, so let's look at this next example also. Okay, so illustration 3. Yeah, and you may just try to compute this on your own while we'll also be looking at the solution. X Limited acquires 70% of equity shares of Z Limited as on 31st March X1 at a cost of 70 lakhs. Okay, yeah. So clearly it's a case wherein X will get control over Z. So that's why Z will become the subsidiary. Following information is available from the balance sheet of Z. Now Z is the subsidiary. So the balance sheet of Z is available on the date of acquisition. PP, investments, current assets, loans, advances, then the liabilities in the form of debentures, current liabilities are also available. The following revaluations have been agreed upon, not included in the above figures. So which means at the time of acquisition, if you look at the book value of PPE in the books of Z, what is the book value? 120 lakhs. If you look at the investments in the books of Z, it's 55 lakhs. But when this will be taken over and when the consolidated financial statements will be prepared, so it's been agreed that the amount of PP and investments will have to be changed. Okay. Further, it says Z Limited declared and paid dividend at the rate 20% on its equity shares as on 31st March X1. Okay, so face value was rupees 10 per share. X Limited purchased the shares of Z Limited at the rate rupees 20 per share. Now, so there's been a dividend distribution as well in this illustration. Okay, and because this dividend has been distributed on 31st of March, which is nothing but the date of acquisition. So can you tell me what should be the accounting treatment? Okay, principally, can you tell me what should be the accounting treatment of this dividend to be paid by Z Limited? What should be the accounting treatment? Okay, great. Swati says it should be considered as pre-acquisition dividend. So how will you treat pre-acquisition dividend? So what will be the accounting requirement? Tell me. So what will be the accounting requirement? Quickly, everyone, everyone tell me what will be the accounting requirement in relation to this pre-acquisition dividend. So if you call it as pre-acquisition, what will be the accounting requirement? Yes. In the consolidated financial statements, how will you treat this? Yeah, waiting for response. Where will you adjust this? Will you take it to P&L? Tell me. Will you take it to the P&L? Will that be okay? The answer is no. Okay, so Swati just mentioned it should be taken to the investments. Yeah, it should be taken to the investments, means the amount of investments will be adjusted as against this. Fine. Now, it further requires to compute the amount of goodwill or capital reserve on the acquisition of shares. Means on the date of acquisition, you are required to compute this. Okay, goodwill or capital reserve. As simple as that. So you are just simply required to get on to the calculation of goodwill or capital reserve. The only thing is that a dividend has been paid out. Okay, and that's been paid out of the pre-acquisition profits or the reserves. Why? Because if the dividend is being paid on the acquisition date, then of course the question of post-acquisition doesn't arise at all. Further, the revaluation is also required to be looked at while computing goodwill or capital reserve. Okay, so let's look at the solution now. So if you go look at the solution, now in this case, amount of PPE is required to be revalued. So if you look at various assets, PPE, investments, current assets, loans, advances, all of them will have to be picked up. Current assets, loans, advances will be picked up as it is. Yes or no? 70 lakhs and 15 lakhs. So they will be picked up as it is. But if you look at investments, they will have to be downward valued by 10%. And if you look at PPE, they will have to be valued upward by 20%. Okay. So with which the total amount of assets will be 278.5 lakhs. So that's the revalued amount. Now, in this case, the second part will be to look at the liabilities. So if you look at the debentures, if you look at the current liabilities, is there any sort of revaluation which has been agreed on that? No. So that's why it will be recorded at the book value. It will be recorded at the book value. 140 lakhs. So the net asset that you get, okay, post revaluation will be equivalent to what? 278.5 less 140 lakhs. So it will be 138.5 lakhs. Okay. Yeah. So that's the total net assets. Okay. Now, X Limited has not acquired 100% shares. X Limited has acquired 70% shares. So that means out of this 138.5 lakhs, 70% belongs to X. Yes or no? 70% belongs to X. So that's why if you look at the proportionate net assets, this amount will become 96.95 lakhs. Correct? Now, proportionate amount of net assets has been computed. Now, what do you need? The second part that you need is the purchase consideration, or you can say the cost of investment, because cost of investment is something which is required to be adjusted against the net assets. Now, in the question, is the cost of investment given to us? Yes. In the question, if you look at cost of investment is given to us, it is 70 lakhs. Okay, 70 lakhs is the cost of investment which has been given to us. But in the question, we also understand that a pre-acquisition dividend exists which will go and reduce this cost of investment. Okay, which will go reduce this cost of investment. So we'll have to consider that. Yes or no? So let's get on to the computation of this pre-acquisition dividend. Now, pre-acquisition dividend question says it is paid at the rate 20%. Okay. Now, if you look at the total cost, it is 70 lakhs. Total cost of investment is 70 lakhs. Purchase price of each share, is that given in the question? Yes, it's rupees 20. So now we need to get on to the number of shares which are purchased. So how do you get it? Total amount which has been paid is what? 70 lakhs. Purchase price of one share is what? 20. So how many shares were purchased by X? How many shares were purchased by X? Tell me. 70 lakhs divided by 20. Yes or no? So that's how you will compute it. 70 lakhs divided by rate per share. Correct? Yeah. Okay. So this number therefore comes out to 3.5 lakhs. Okay. Now, as against this 3.5 lakhs, we understand the face value per share is rupees 10 per share. Face value per share is rupees 10. Now, if the dividend is paid at the rate 20%, so what does it mean? 20% of rupees 10 has been paid as dividend. Means for every share rupees 2 is paid. So how many shares do we have? 3.5 lakhs. For every share rupees 2 is paid. So that's why what is the total amount of dividend which has been paid? 7 lakhs. Total amount of dividend which has been paid, or which will be the amount of dividend will be 7 lakhs. Okay. Now this 7 lakhs is what? This is the pre-acquisition dividend amount in relation to the holding company. So that's why what will you do? You will adjust it over here. Okay. So the cost of investment for the purposes of calculation of goodwill or capital reserve will be 63 lakhs. Why? Because 70 lakhs is loaded with the amount of dividend. Okay. So the cost which has been paid to acquire these net assets is what? 63 lakhs. So is this consideration paid in excess of the net assets or lower than the net assets? This is lower than the net assets acquired. So that's why what do you get? Capital reserve. Okay. That's why you will get capital reserve, which is 33.95 lakhs. All right. Everyone clear on this? Any questions if you have? Tell me quickly, any questions, any doubts if you have? Everyone clear on this? Right, so Swati is clear. I'm just hoping other students are also clear on this. Yeah? Clear on this? All right, great. Okay, great. So Manish is also clear. Great. So let's move further. So now we'll look at some more adjustments. Okay. So let's look at some adjustments in relation to elimination. Okay, so let's try to understand this concept of elimination first, and then we'll talk about those adjustments. Now, what do you mean by elimination? Why is this elimination required to be done? And how that elimination is required to be done? Now, in relation to the company's financial statements, I'm not talking about consolidated financial statements. I'm talking about financial statements of a company, means standalone financial statements. In the previous sessions, we have discussed that if the branches are carrying out any transactions, so let's suppose there's a company A Limited, okay, and A Limited, let's suppose, has got 3 branches: branch 1, branch 2, and branch 3. Let's suppose these are the 3 branches. Now, if let's suppose branch 1 carries out a transaction with branch 2, so let's suppose there's a sale from branch 1 to branch 2, branch 2 to branch 3. Okay, say branch 3 sells goods outside the company worth of 10 crore. Branch 1 has sold to branch 2 1 crore. Branch 2 has sold to branch 3 1.5 crore. Okay, now in this case, when the company's financial statements will be prepared, will you consider these transactions or these sales which are taking place between the branches? Tell me, while looking at the turnover, while looking at any adjustments, will you consider all of these adjustments which are taking place between the branches? Tell me quickly, everyone, will you be considering that? What do you think while preparing the financial statements of A Limited? We discussed this earlier. Swati says yes, we'll consider those as inter-branch transfers. But tell me, when you prepare the when you prepare the financial statements, what is going to be the amount of revenue for A Limited? What will be the amount of revenue for A Limited? Will you include 1 crore, 1.5 crore along with 10 crore and then give the total amount of revenue? Or will you not be considering these revenues of the branches? What do you think? Tell me, what do you think? Quickly. Everyone, what do you think? How will you treat this? Will you be considering that? Kushi is saying no. This will not be considered. Yeah? And what is the reason for doing that? Because when the financial statements of a company are prepared, yeah, like I mentioned, it should be 10 crore. Why 10 crore? Because when the financial statements of a company are prepared, only the transactions which are taking place outside the company. So if you say this is the company, yeah? So within these boundaries, this company is operating. So anything which falls outside of the company, that is what you will say belongs to the company. But if there is something which is moving within the company, from B1 to B2, B2 to B3, B3 to B2, okay, whatever be the case. So yes, For accounting purposes, you can consider that. But at the company's level, what will you do? You will eliminate that. You will ignore that. Yes or no? You will eliminate that. Otherwise, what will happen? Otherwise, you will inflate the numbers unnecessarily. Correct? Is that the thought process or not? Everyone, tell me. Yes or no? Now, same is the approach which you are required to consider while preparing consolidated financial statements. Okay, so we are just extending this concept to consolidated financial statements. So let's try to understand as to how this will be extended to the consolidated financial statements. Now, when the consolidated financial statements are prepared, okay, therein we understand, let's suppose there are two companies. One is H Limited, holding company, and other one is, let's suppose, S Limited, subsidiary company. Okay, and both of them, when you combine them, what do you call it as? When you will combine them, you will say this is a group. It's a group. Yeah, so that's how you will consider it. When you combine them, you will say it's a group now. Yes or no? It's a group. Right? Now, in relation to this group, now let's try to understand as to what is required to be done. In relation to this group, when you prepare the consolidated financial statements, what is your approach? Your approach is that you consider as if H and S are not two separate entities. Instead, you consider as if it is single economic entity. Means this group, which comprises of two companies, is actually not two companies. This is actually a single economic entity. So that's how it operates. That's the approach we have considered so far. Tell me, yes or no? Everyone quickly, I'm waiting for a response. Do you agree with this? That's the approach we have considered so far. Okay, great. Manish, Swati, they agree with this. Great. All right. So now, if you are considering the same approach, that yes, for the purposes of our financial statements, which is nothing but consolidated, these are not two separate companies, but actually these are this is one single economic entity. Therefore, in such a case, what should happen? If there is any transaction between these group companies, means from H to S or S to H, then while preparing consolidated financial statements, should you be considering that? No, you should be eliminating them. You should eliminate that exactly on the same lines like you do while you prepare financial statements of a company. Okay, exactly on the similar lines. Okay, this is what you call as elimination, or you can say adjustments related to elimination. Means while preparing the consolidated financial statements, if there are any transactions between the group companies means companies which fall within that group. Okay, or you can say intercompany. Intercompany means what? So when you use the term intercompany, what does it mean? In our example, this will mean H and S, means between H and S. Or you can use the term intragroup. So what do you mean by intragroup? Intragroup means within this group, within the group that we are looking at, within the group. And within the group means what? Once again, H and S only. Yeah, that is nothing but H and S only. Okay, clear on this? Yeah. So therefore, whenever you come across any sort of transaction which is between the group companies, you will have to eliminate that. Yeah. So that's the principle we just discussed. Now the question arises that how do you eliminate that? So for this elimination, there are few terms we need to understand. That term may be used sometimes in the question also, or otherwise it will be important, or you can say beneficial for you to remember those adjustments as to how this elimination is required to be done. So we'll look at the transactions between H and S now. Okay. So we have H Limited, holding company, and S Limited, which is the subsidiary company. If holding company sells goods to S Limited, okay, possible? Yes, because these companies may also transact with each other. So holding may sell some goods to the subsidiary company, which is okay. Yeah. So what do you call this transaction as for the purposes of reference? We can call this as downstream transaction. Downstream transaction. Downstream means going from top to bottom. Okay. Why? Because holding will sit above subsidiary. Okay. So going down. Now, in this case, when the holding will sell goods to S Limited, so let's suppose cost of those goods to H was 100. So this was the cost, and H built a markup on this. Let's suppose there was a markup of 25. Markup is nothing but the margin or the profit. Let's suppose this is the margin, and these have been sold at the rate rupees 150 to S Limited. Okay, now in this case, what will happen? If you look at the group, it's a transaction which has taken place within the group. Ultimately, these goods have not moved out of the group. Why? Because if these goods were not sold, H would have held this inventory as at the end of the year, amounting to what? 100. But now, in a way, what has happened? This inventory has shifted to S. So this inventory has got shifted to S. And instead of getting recorded at 100, this is getting recorded at 150 at a markup. So at a group level, is that appropriate? No. Why? Because group has not made any profit. H may have made the profit, but that is not relevant for us. For what is for us, what is relevant is whether the group has made the profit or not. And the group will make the profit only when this inventory will fall outside the group. So if let's suppose this is the boundary, till the time this inventory is not sold outside, okay, so there's no profit. That's only notional profit, which is currently looked at, or which appears to be there in the consolidated financial statement. So that's why what is required to be done in such a case? What will you do? You will have to eliminate this profit. You will have to eliminate this margin. Okay. So how will you eliminate that? At the level of H, you will say sales are required to be reversed. At the level of S, you will have to reverse the purchases, because H would have booked sales, S would have booked purchases. Okay, so that is going to be the first elimination. Second will be, in the books of S at the year end, there will be an inventory. Actually, this inventory at the group level should have been valued at what amount? Can you tell me? At the group level, this inventory should have been recorded at what amount? Tell me quickly, at the group level, at what amount this inventory should have been recorded? Over to you. What do you think would have been the right amount? Great. So Swati says it should be 100. It should be 100. This would have been the appropriate amount. But now this is appearing in the books of the group at 150. Okay, so that's why that 50 markup, or you can say the amount of inventory, is sort of extra, which needs to be removed. So what will you do? You will cut down on the valuation of the inventory. You will cut down on the valuation of the inventory. Okay, and what will be the corresponding impact? H, who has booked the profit, needs to reverse this profit, because this entire profit is sitting in the books of H. So H needs to remove this profit from its books, okay, from the P&L. Okay. Now, there is another way this transaction may take place. Let's try to understand that. Sometimes what may happen is that this transaction may move from S to H. So in the first example, we looked at the sale from H to S. Similarly, there could also be a sale of goods from S to H. Now, for the purposes of accounting, we call this as upstream. Upstream transaction means moving from subsidiary to holding. Okay. Now here again, we'll have a similar situation. If let's suppose cost of inventory was 100, which has been sold at 150. So there's a notional profit of 50, which needs to be removed along with the elimination of purchases and sales at both the sides. Okay, inventory will have to go down even here also. Yeah. But in this case, who has made this profit of 50? Can you tell me? In this case, who has made this profit of 50? Is it H or S? Over to you. Who do you think has made the profit? In this one, who do you think has made the profit? Swati says S Limited. What about others? Quickly, Kavita says S Limited. Very good. So now, in this case, because S would have made the profit, so that's why S, if you look at the P&L of S, this profit of 50 would be appearing. Means now, when you look at the consolidated financial statements, wherein P&L of S Limited will go, in that P&L of S Limited, this 50 would be appearing. And if let's suppose S is a subsidiary which has also got minority interest, in such a case, will this 50 belong to the holding company completely? The answer is no. So some portion of this will go to holding and some portion of this will go to minority. So that's why when this elimination will be done, when this elimination will be done, so what will you do? You will have to eliminate this from the holding as well as the minority interest. Okay, only then this will be appropriately reflected in the books. Okay, in the consolidated financial statements. Fine. So in relation to this transaction or this sort of elimination, what we can do is we can just also look at one example. Okay, so I think we've got one example on this. We can go look at this example quickly. All right, so we can go to the study material and refer this page number 10.72. Okay. So this illustration 14. A Limited holds 80% of equity capital and voting power in B Limited. Means A is the holding, B is the subsidiary. A Limited sells inventories costing 180 lakhs to B Limited at a price of rupees 200 lakhs. Okay, so that's the arrangement. Okay, wherein A Limited has sold inventory costing 180 lakhs to B, so there's a markup of 20 lakhs. Now in this case, because A has sold to B, so what will you call this transaction as? This will be upstream or downstream? Tell me quickly. What do you call this transaction as? Upstream or downstream? Downstream? Okay, great. So Kavita says it should be downstream. Yes. Why? Because it's going from holding to the subsidiary. Yeah. Same is the response from Manish, Swati. Very good. All right. Entire inventory remain unsold with B Limited as at the end of the financial year. So in this case, can you tell me what will be the adjustment? Can you tell me what will be the adjustment? Over to you quickly. In this case, how should this be adjusted while preparing the consolidated financial statements? Okay, so Swati is saying reduce the notional profits. So how do you reduce the notional profits? Can you tell me? So it's good to reduce the notional profits, but how do you reduce that? What all adjustments you will be required to do to reduce the notional profits? Tell me quickly. We just discussed this, everyone. How will you reduce this notional profit? Should we go to the answer? Yeah? Should we look at the solution? All right, so let's go look at the solution now. So in this case, clearly it's a downstream transaction. If you look at the consolidated P&L, A would have recorded a sale, B would have recorded a purchase. So what is going to be the first step? Sales and purchases will be eliminated. Okay, so in the P&L, what will you see? Elimination of sales and purchases. So that's what you will do. Okay, so that's one. Now, further, inventory, which is now overstated by 20 lakhs in the consolidated balance sheet. So that will have to be reduced. Inventory will have to be reduced by 20 lakhs because inventory is overstated by 20 lakhs. And on this inventory, there is a profit of 20 lakhs, which you call it as a notional profit or unrealized profit. Unrealized means which is not actually realized by the group. Okay. Now, holding company would have recorded this profit. And from the financial statements of holding company, this would have flown to the consolidated financial statements. So that's why from the consolidated profits, from the consolidated P&L, this unrealized profit of 20 lakhs will also be eliminated. Okay. So this is going to be the accounting adjustment. Understood? Everyone? So whenever you answer this, so this is how you are required to answer. Okay. So to say that you will just eliminate the notional profit, so that will not be sufficient. You'll have to explain as to what all steps you will perform, what all adjustments you will be required. Okay. All right. So let's look at the second example. A Limited holds 75% shares in B. So again, it's a holding subsidiary relationship because of 75%. A Limited purchases goods costing 150 lakhs from B at a price of rupees 200 lakhs. So in this case, we have a reverse sort of situation wherein the subsidiary is selling to the holding company. So that's why, what will you call it as? You will call it as upstream transaction. This will be an upstream transaction. Okay. Entire inventory remain unsold with A Limited as at the end of the financial year. Now, in this case, inventory is unsold. Means the group has not made any actual profit, or the group has not realized any profit on this inventory. But by moving this within the group, company, or you can say the group, is unnecessarily inflating the amount of inventory as well as the profit level. So that's why what needs to be done while preparing the CFS, this needs to be eliminated. So how do you eliminate that? Okay, how do you eliminate that? One, in the consolidated P&L, sales and purchases will be eliminated against each other. Yes or no? Sales and purchases will be eliminated against each other. So that's one. Number two, inventory will have to be cut down by 50 lakhs. Why? Because inventory was overstated by 50 lakhs. Okay. So that's going to be the third adjustment. Fourth, this unrealized profit of 50 lakhs would have been recognized by subsidiary. And from subsidiary, this would go to two parties. What are those two parties? Holding and the minority interest. So therefore, A Limited share of profit from B will be reduced by 37.5 lakhs. How do you get this amount? 75% portion of 50 lakhs. Okay. Yeah. And the other adjustment will be minority share of profits of B Limited would be reduced by 12.5 lakhs. So how do you get 12.5 lakhs? 25% of 50 lakhs. Okay. So all in all, this 50 lakhs is eliminated. That had to be eliminated, so that's been eliminated. But now, because this is sitting at two places, one with the majority, that is nothing but the holding company, other one, that is minority. So from these two places, this will have to be eliminated. Understood? Everyone? Any questions on this? Everyone clear on this? Any questions? So Kavita is clear on this. Great. Any questions, doubts, if you have, please let me know. Swati is also clear. Very good. Yeah. All right. So let's move further. Let's look at another adjustment. Now the other adjustment is in respect of alignment of the reporting dates. Now what do you mean by alignment of reporting dates? Sorry. So when the consolidated financial statements are prepared, so let's suppose there are two companies. One is H Limited. One is H Limited. This is the holding company. Let's suppose holding company follows financial year. Okay. So this is from 1st April to 31st of March. Okay. So let's suppose this is the financial year which is followed by the holding company. And let's suppose this S Limited subsidiary company which follows, say, calendar year, which is what? 1st January to 31st of December. Okay. Let's suppose this is how the reporting dates of the holding and the subsidiary look like. Okay, and why is that so? Maybe their reporting years are different. Okay, now standard says that for the purposes of preparation of consolidated financial statements, what should you do? You should first of all ensure that both these companies have got same reporting years. Okay, so that should be your step number one to look at. Okay, if they are following the same reporting years, means if let's suppose they have same period, April to March, then there's absolutely no problem. Why? Because both of them will prepare financial statements from April to March, which will then combine. And that's how the CFS will be prepared. But if let's suppose there's a change in reporting years and thereby change in the reporting dates. Reporting dates means for H, reporting date is 31st March, but for S, reporting date is 31st December. In such a case, what do you do? Standard says in such a case, you should ensure that the gap, okay, so now this is the gap. You can just look at this is the gap between the reporting period ends of two entities is not more than 6 months. Okay, so up to the extent of 6 months, if this gap exists, then that will be acceptable. Okay, so while preparing the financial statements of the subsidiary company, if let's suppose subsidiary company follows a period which is not aligned with the period which is followed by the holding company, then the gap up to, we are not saying it has to be 6 months, up to 3 months. In the current example, this gap is actually 3 months. Okay, so should we say that we should increase the gap to 6 months? The answer is no. See, the first step should be what? To make sure or to come and try to align these reporting years. Okay, if let's suppose that is not possible, that is when you get on to this second step. Okay, wherein the maximum permissible gap should be 6 months, not beyond that. Further, what will you do? Further, for this gap, for these 3 months, which are currently being lost, or whether it's 6 months, if there is any significant transaction during this period, that should also be taken to the consolidated financial statement. So what will happen? When the CFS of this group will be prepared, so what will they do? So now what they will do is say these are two companies. Okay, so we have H and S, wherein for S these 3 months are missing right now. Okay, so we'll pick up the financial statements like they are, but for these 3 months, if there are some significant transactions, now how do you cut down to the significant? That will be dependent on the materiality of the group. Okay, all those significant adjustments will have to be considered. So we can say gap of 6 months. So what is going to be the principle? So we can say gap of 6 months. Maximum is permissible, but in that case, what do you need to do? Plus, you will have to add significant transactions. Which would have taken place during the 6 months or 3 months or whatever is the period of gap. Okay, so that's how you'll have to approach that in such a case. Understood? So this is how you'll have to move whenever there is any such gap. All right. So this is how this will be required to be considered every time there is a gap. All right, clear on this? Any questions, any doubts if you have, please ask me. So this is all about alignment of the reporting dates. So any questions, any doubts if you have, please let me know. No, so it seems Swati is clear. What about others? Tell me quickly, any questions, any doubts if you have? Kavita is also clear on this. Okay. So Malu is saying how to adjust those 3 months. See, adjustment means I understand you're talking about this significant transactions. Huh? So what you will do is you will pick up the financial statements of the subsidiary. Okay. Now in the financial statements of the subsidiary, a period is missed out. Yes or no? What period is that? Let's suppose this is 3 months in our example. Okay, whatever period is that. So therefore, in the books of subsidiary, you'll have to go and check. Even though the subsidiary is not preparing the financial statements for these 3 months, you'll have to go and check if there are any significant transactions. If the transactions are significant, what will you do? In the financial statements, you'll have to pass the adjustments for that. Means you'll have to incorporate that. You will have to incorporate that in the consolidated financial statements. Okay, so that's how this will be required to be adjusted. Clear? Malu, clear on this? Any more questions? Any more doubts? No? Everyone clear? All right, so now moving further. Now, similar to the alignment of the reporting years, accounting policies of the companies within the group, they should also be uniform. So while preparing the CFS, if let's suppose there are 2 companies, A Limited, B Limited. Sometimes what may happen is that these 2 companies may be following different accounting policies. Yes or no? Possible or not? Yeah. These 2 companies may be following different accounting policies. Now, if that were the case, wherein there are 2 companies which are required to be added together, effectively in the case of CFS, what do? You do line by line addition for A as well as B. So you are effectively merging them, sort of. Yeah. So if you are required to combine them, how will that be possible? If the accounting policies which both of these companies follow, they are not aligned. For example, let's suppose inventory in case of A Limited is recorded using FIFO method, and in case of B Limited, inventory is recorded using weighted average method. Okay, now when you will combine their financial statements, okay, when you will add them together, let's say A Limited has got an inventory of 1 lakh, B Limited has got an inventory of 3 lakh. So what will you do? You will just simply add these 2. While preparing the consolidated financial statement, you will add these 2. So in the consolidated financial statement, what will happen? Inventory will appear at 4 lakh. Yeah. But when the consolidated balance sheet is looked at by any user, so what will happen? That will be misleading. Why? Because some part of this is recorded using FIFO and some part of this is recording using some other method, okay, which is not appropriate. Which is not appropriate. So that's why, what does the standard require? This standard requires that for the purposes of consolidation, accounting policies of the companies within the group should be uniform. Uniform means they should be aligned. Now, it doesn't mean that at a standalone level you need to go and change it. See, practically, whenever such situations will arise, so the holding will generally ask the group companies to change their accounting policies at a standalone level. Okay, so that this complication, this unnecessarily exercise which is required to be done for the purpose of consolidation will go away. But if let's suppose that is not done, then what will happen? Every time the consolidated financial statements are prepared. Now, please remember, this entire exercise is for consolidated financial statements. So every time the consolidated financial statements are being prepared, what will happen? Some sort of adjustment for this alignment will be required. Okay. Yeah. And by doing that adjustment, this CFS can be prepared. If that is not done, then what will happen? Then the information which is produced in relation to those line items will be misleading. Okay. Understood? So that's why uniformity as far as financial statements is concerned is extremely important when it comes to the consolidation of the holding and the subsidiary company. Okay. So now on this alignment, what we can do is you can also look at one example. Yeah, but I think if you have any questions, any doubts before that, you may just let me know and then we'll take a break and then we'll get on to this example. Okay. Tell me any questions, any doubts so far on this? Yes, any questions, any doubts? Clear on this alignment requirement for the uniformity of the accounting policies? Everyone? Great. All right. So what we can do is we can take a break now. And after the break, we'll continue with our discussion and we'll also pick up this example for the uniform accounting policies. Okay. So Sorry? All right. Okay. Hi, welcome back. So we can continue with our discussion. All right. So now in relation to this alignment of accounting policies, let's try to look at one example. Okay, so you can just go to this page number 10.80. Yeah, so let's look at this illustration of 16. So we have this subsidiary B Limited for which the balance sheet is available for 2 reporting years. Okay, X0, X1. We have this share capital reserves. So reserves have changed, they have increased. Then you look at the liabilities. So we have short-term borrowings that have increased, trade payable, short-term provisions. Okay, so this is the balance sheet information. I'm just quickly flipping through that. Then we have the information about the assets. PP, then non-current asset is there. Sorry, non-current investment is there. Then various current assets are there: inventory, trade receivable, cash, other current assets. Okay, then the further explanation in the form of notes is given to us. Share capital, reserves, short-term borrowings, that's a bank overdraft, short-term provisions, that's a provision for taxation. PP, other current assets, is all about prepaid expenses. Okay. Then there is some additional information available. Okay. Now, if you look at the additional information, so it says B Limited is a subsidiary. Yeah. So it's a subsidiary of A Limited. Both the companies follow calendar year as the accounting year. So which means that in this particular question, alignment of reporting dates will not be required. Fine. Great for us. Then it says A Limited values inventory on weighted average method, while B uses FIFO method. Okay. So it appears that the accounting policy in relation to valuation of inventory of holding and subsidiary are not same. But let's understand this further. To bring values of B Limited in line with those of A Limited. Okay. A Limited is the holding. Its value of inventory is required to be reduced by 12,000 at the end of X0 and 34,000 at the end of X1. Fine. So this is what is required to be done. B Limited deducts 1% from trade receivables as a general provision against the doubtful debts. So that's the provision which B Limited is following. So it's a general provisioning norm which B Limited follows. If you look at the prepaid expenses in the books of B Limited, it includes advertisement expenditure. Okay, so there's an advertisement expenditure which has been carried forward of 60,000 in X0 and 30,000 in X1, being part of initial advertisement expenditure of 90,000 in X0, which is being written off over 3 years. Similar amount of advertisement expenditure of A Limited has been fully written off in X0. Okay, so in case of B Limited, what has happened? So B Limited incurred an expenditure on advertisement, but didn't charge it to P&L straight away. Instead, what did they do? So they are amortizing it over a period of 3 years. Now, where does this basis come from? Nobody knows. Number one. Number two, even if you look at the accounting policy of the parent, that is not aligned with B. So what did the parent do? They also incurred similar expenditure, but they charged that expenditure completely to the P&L. But B, because it is amortizing, so that's why B still has this balance appearing as at the end of second year. By first year, it got reduced by 30. Second year it again got reduced by 30,000. Okay. Then it says restate the balance sheet of B Limited as at 31st December after considering the above information for the purposes of consolidation. Number one, would the restatement be necessary to make the accounting policies adopted by A Limited and B Limited uniform? Okay, so in this case, you are required to answer a couple of things. One, the question is asking you that there are some accounting requirements which subsidiary has done, which is not aligned with the parent. So is that mandatory? To that, the answer is what? Yes, of course, that is mandatory. Okay, so that is required to be done. If that is required to be done, it further says, then you are required to make those adjustments and get on to the revised numbers of B Limited, so that that revised balance sheet, or you can say the revised set, can then be used for consolidation. Okay, clear on this? Yeah, so this is what is required to be done. So what we will do is we'll look at all of these adjustments one by one. Yeah. So now, first of all, can you tell me in this question what all things are required to be adjusted by B Limited? Over to you quickly. What all things you think is required to be adjusted? Which all adjustments you will consider for B Limited? Okay, forget about the numbers and the adjustments. I think there are 3 adjustments. Huh? You can just let me know whether those are required to be corrected or not, or adjusted or not. So one is on inventory, second is on trade receivables, and third is on expenditure related to advertisement. So what do you think is required to be adjusted? What do you? So Swati says inventory will require adjustment. Current assets will require adjustment. So when you are saying current assets, in what context you are talking about current assets? Yes, and what about others? Quickly, huh? What all adjustments you think will be required? Means in relation to which area? Yes, quickly. Over to you. Where do you think adjustment will be required to be done? Where do you think? Okay, great. So Khushi is saying for all 3 adjustment will be required to be done for all of these 3. Means for inventory, for trade receivable, advertisement, expenditure. Yeah, great. So let's try to look at all of these one by one. Okay, so we'll not try to get into the balance sheet or the P&L or all of these information, because that is not what is required to be done. So currently we'll focus on the alignment only. Yeah, so that's the approach that we are going to consider. So now the first piece is about the inventory. Okay, now in relation to the inventory, if you look at, so if you go and look at the balance sheet, in the balance sheet, if you look at the inventory is valued at original value. Huh? So inventory is valued at 7,42,000. Correct? Yeah, so that's the original amount. Now the question further says that to bring the values in alignment with A Limited, B Limited is required to reduce its inventory by 12,000 at the end of X0 and 34,000 at the end of X1. Okay. So something which will be done in the previous year so that will be of no adjustment eventually, because if you change the closing stock as well as the opening stock, so the impact will be same. Yeah. So that's why we are considering the numbers as at X1. Okay. So now at the end of X1, question in itself says reduce the value of inventory. So you are not required to assess whether increase is required or decrease is required. You are just simply required to assess whether this change is required. Yeah. So if that is required, what will you do? You will reduce the amount of inventory. Okay. So that's the first impact. But the corresponding impact, where will it go? So if you reduce the amount of inventory, so what will happen? So if you reduce the amount of inventory, so the reserves will be hit. So if you look at the balance sheet of B Limited, this has got a reserve of 7,40,000. Okay. So corresponding to this, the impact will also go on the reserves. Yeah. So the reserves will also get adjusted by the similar amount, 34,000. Yes or no? Yeah. So this is your first impact. Fine. All right. Now, with this, our adjustment related to inventory is sort of completed. Okay. So that is first part to this. Okay. Now, let's move on to the second adjustment, advertisement expenditure. Here again, what we will do is we'll get on to the balance sheet. We'll get on to the balance sheet. Yeah. So in the balance sheet, this amount has been capitalized. So this amount has been capitalized. So what we'll do is we'll just take out this amount from the balance sheet also. So in the balance sheet, if you look at, so they are saying that this has been appearing in the balance sheet as the asset. So now in the balance sheet, if this is appearing as an asset, so what will you do? You will have to just remove this from the asset side also. Okay, so from the asset side also, this will have to be eliminated. Okay, so now, if you look at the asset side, on the asset side, we have got other current assets in which prepaid expenses is the amount which includes this advertisement expenditure amounting to 30,000. Okay, so this 30,000 is the amount which is appearing as an asset. So what should you do? You should cut down the value of this asset. So if you cut down on the value of this asset, what would this balance become? This would become 18,000. So this would get reduced to 18,000. Okay. Yeah. So this will get reduced to 18,000. Fine. So now we have got the revised amount of other current assets and its corresponding impact will also have to be considered. So where will you take the hit? So this hit will again go to the reserves. So if you cut down the value of asset, corresponding impact will also be taken to the reserves. Okay. Yeah. So this second adjustment is also completed. Now, in this example, if you look at the adjustment related to advertisement expenditure, see, there are two problems in this. Okay, so I'm talking about this adjustment number D. So there are two problems in this. One, if you look at the policy adopted by B Limited, this is not in alignment with what A is doing to begin with. Okay. Further, we can also say that whether A is following the same accounting policy or not. So that's a separate thought process. If you look at the accounting policy of B Limited, that in itself is incorrect. Why? Because advertisement is not allowed to be capitalized. Yes or no? So can you go and capitalize the amount of expenditure in relation to the advertisement? Is that permissible? So if you look at the requirements of the accounting standards, can you capitalize the expenditure on the advertisement? Is that permissible? What do you think? Is that permissible? Can you do that? What do you think? Is that allowed to an entity to capitalize it? The answer is no. That is not allowed to be done. Yeah. Swati says no. Very good. So now you should be looking at both the aspects whenever you answer this. Okay. Now similarly, you are also required to evaluate this adjustment which B Limited has been making in respect of trade receivables. Okay. So B Limited is creating a provision for trade receivables equivalent to 1%. Okay. And it appears as if company is not doing any sort of evaluation right now. Now, if you look at the provision for trade receivables, can you tell me why is that provision required to be created? Why would a company create a provision for trade receivables? So whether that is general or not a general provision, let's ignore that. Principally or conceptually, what do you think? What is the rationale for creating a provision for trade receivables? Over to you. Why do you think provision for trade receivables should be created by a company? Tell me quickly. Why do you think a company will create a provision for trade receivables? Over to you, quickly. Yes, everyone. I'm just hoping everyone is with me. Yes. Why do you think a provision for trade receivables should be created? Okay, great. Swati is saying, in case the trade receivables are not able to make the payment to the company, okay, or the company believes, like Khushi mentioned, that it's probable the money will not be received from them. So what do? You will create a provision. Huh? Very good. Now, in this case, whenever you will create this provision, so what is going to be the step which the company will take? So company will assess. Assess means company will evaluate. Company will have to just get into this assessment whether the money is receivable from the trade receivables or not. Okay, which has to be done on a party by party basis. It cannot be done in an ad hoc manner, or the company cannot just simply say that on an ad hoc basis 1% of the amount will not be received. Why? Because against this 1%, what is the basis? So how can the company come and say that 1% is not collectible? Okay, or 1% trade receivables are going to default on this. Is there any basis available with the company? If yes, that is what you call as assessment. If the basis is not available, then you will call it as ad hoc provision. Okay, for which some basis is not available. So something which is done in an ad hoc manner for which the basis is not available. So is that acceptable? If you look at the requirements of the accounting standards, the answer is no. The answer is no. Okay. So now in the given example, question doesn't say whether the parent is following similar accounting policy of 1% of the trade receivables because of which B is following this, or there is some other reason as to why B is following this. So this is not specified. Okay. Now, on a standalone basis, therefore, we need to evaluate this policy which is being followed by B Limited. Yeah. So what I mean to say here is that it's not that because the parent is following a different policy in relation to trade receivables, so that's why this adjustment is required to be done. No. Irrespective of that, we'll be required to do this assessment. Okay, irrespective of that, we'll be required to do this assessment. Okay, so now, if you look at the closing balance of the trade receivables, what is the closing balance? It is 8,91,000. So this is the closing balance, and this closing balance is arrived at after deducting 1% provision. Why? Because provision has not been disclosed anywhere else. So we have good reasons to consider that this provision is adjusted with the debtor itself. This provision is adjusted with the debtor itself. Okay, and in fact, the company also says deducts the amount from the trade receivables. Okay, so therefore, what will be the amount of debtor without considering this provision? It will be 9 lakh. It will be 9 lakh. To that 9 lakh, what is it that the company would have done? To this 9 lakh, the company would have adjusted. If you look at the debtor, the company would have adjusted a provision of 9,000. Yeah, so that's how this balance would have been derived. So now what do you need to do? Because it's an ad hoc provision for which the justification for the basis doesn't seem to be there with the company, so that's why this provision needs to be reversed. So what will you do? To the closing balance, you will add the provision and you will get on to the gross balance. So that's why debtor will have to be moved upwards. Debtor will have to be moved upwards. So instead of 891, the debtor will have to be recorded at 9 lakhs. Okay? Yeah? And the corresponding impact on this will once again go to what? Reserves. Yeah? But in this case, the reserves will not go down, unlike what we have seen in the previous two adjustments. In this case, the reserve will go up. The reserves will go up. Okay? So therefore, if you look at the overall impact as far as the reserves are concerned, the revised amount of reserves after all of those impacts will be 6,59,000, which will be taken to the balance sheet. Okay, which will be taken to the balance sheet, because reserves is all about these reserves only. Correct? Yes or no? Yeah. So if you look at the remaining part of the financial statements, balance sheet, notes, all of those things remain intact. So they are not going to change. Why? Because we are not moving from one period to another period. Number two, we don't have any other adjustments except for the changes in the policy or any sort of errors which have been made by B Limited. Yeah. So these are the only two adjustments. Okay. So that's why we are not getting into the preparation of this complete balance sheet or all of these notes to accounts. You can always practice that later on. Our whole idea was to discuss as to what all adjustments are required to be done when the consolidation exercise will be going on. Number two, it is not necessary that in the question when you look at, even if that sometimes belong to consolidation, that all of those adjustments will be limited to the consolidation. Like for example, in this question, you have an adjustment which has got nothing to do with consolidation, but wherein you find there is an error in the accounting. So if there is an error in the accounting, will that be required to be corrected? The answer is of course yes. Okay, because this is clearly evident. So the moment you see some error, of course you'll have to correct that and you'll have to give a working for this. And what is going to be the working? Of course, something like this, wherein you have talked about the reserves, wherein you have also explained the adjustments in the debtors balance. All right, clear on this? Yeah. Any questions, any doubts if you have so far? Quickly. Any questions and doubts? Everyone clear so far? Okay, so Swati has a doubt regarding AS13. No worries. You can just put across your question and maybe any other topic that you want to have a doubt on, maybe towards the end of the session, we can have a discussion around that. Okay. Yeah. Okay. Any other questions that you may have as around something that we have discussed just now? No? So what I'm going to do is I'm just continuing on this consolidation now, but now I'll move on to the next accounting standard. Okay. Please remember that consolidation is not limited to AS21. So there are other accounting standards which deal with the consolidation requirements. Okay. So now I'll move on to the another accounting standard. So just give me a minute. I'll just change the presentation. Just give me a minute. All right, so let's move on to the next accounting standard, which is about associates, okay, which is in relation to AS23. Yeah. Now associates. So let's try to understand about associates first of all, as to what is an associate, what is the understanding of associate, okay, what is the relevance of associate in the context of consolidation, and then we will also look at the consolidation adjustments in relation to associate. Fine. Now, what is an associate? For associate, we need to understand that whenever there are two entities or whenever there are two companies. If let's suppose one company holds some shares of another company. Okay. So earlier in case of subsidiary, every time we used to check whether this share by A in B is greater than 50% or not. Yes or no? So this is something we used to check every time. But now we'll not be checking that. So what is going to be the next thing that we'll check? Now we'll check whether A Limited has got significant influence over B Limited. In case of subsidiary, we were looking at control, whether A has control over B, for which we checked whether shareholding voting power is more than 50% or not. Now we'll check significant influence. Now for checking significant influence, what do we need to do? So the standard says significant influence may be gained by share ownership, statute, or agreement. Okay. Now in relation to the share ownership or voting right, any enterprise having 20% or more of the voting power will be assumed to have significant influence over that another entity. Means, if let's suppose A Limited holds 21% shares of B Limited, thereby getting 21% voting right. Now, can we say that A Limited has got control over B Limited in this example? Tell me, can we say that A Limited has got control over B Limited in this example? The answer is no. We can't say that. Okay, we can't say that. Why? Because for control, at least 50% has to be there. But because it is at least 20%, or you can say greater than 20%, less than 50%. Okay, which is greater than 20, less than 50%. So that's why in this example, in this situation, what will happen? It will be considered as if A Limited has got significant influence over B Limited. Okay, in this case, who is A Limited? A Limited is any investor. A Limited is like any investor who holds shares of B Limited. Okay, so A is any other investor. But the point is whether this investor has got significant influence over B Limited or not. Okay. Now, if in case there's an entity that does not have 20% or more voting right, then it will generally be assumed that this significant influence does not exist. Okay, so which means if this is less than 20%, then the significant influence should be assumed to be nil, until unless it's proved otherwise. So how do you prove it? Through contracts, through the agreements, through the understanding. Okay, so all of those aspects will have to be looked at. Fine. So this is how significant influence is established. The moment we say A Limited has got significant influence over B Limited, so what will happen? B Limited will be called as associate. B Limited will be called as associate of A Limited. Okay, so in this case, B Limited will be considered to be associate of A Limited. Okay, and Let's come back to the consolidation requirements. Now, why is this relevant for us? See, when it comes to the consolidation, consolidated financial statements are not only prepared for subsidiary, they are prepared for associates as well. Okay, so if in case there is an associate, even for that associate, consolidated financial statements may be required to be prepared. Yeah, so that's the relevance. That's how this is required to be looked at. But in relation to associates, in relation to their accounting, in relation to their assessment, whether that's an associate or not, in relation to the steps of consolidation which are required to be followed, this entire guidance is not available under AS 21. Why? Because AS 21 is limited to subsidiaries. It talks about those situations wherein you'll have control. But you have a different accounting standard now, AS 23, okay, which deals with the associates, which deals with the situations wherein the significant influence will exist. Okay, clear on this? Yeah. Now, let's try to also understand as to what is the meaning of significant influence. Okay, we'll just try to understand this conceptually, and then we'll also try to evaluate some of these things. Okay, so Swati has a point. Swati is saying, sir, AS 21, we are calculating minority interest. Okay, and when we calculate minority interest, so actually that is the shareholding by those parties or a party which is other than the majority. Okay. Now in AS 23, those minorities could be the investors. Yes, we can say that. For example, let's say this is C Limited. Okay, and this is A Limited. Let's suppose 70% shares of C are held by A. Okay, so in this case, C will become subsidiary for A. For A, C will be a subsidiary. Now, remaining 30% of C, if let's suppose are held by B Limited. So B holds 30%. Now B will be considered to be the minority interest. B Limited will be considered to be the minority interest. Yes or no? B will be considered as minority interest when, while preparing CFS. Who will prepare that CFS? A. So A, while preparing its CFS, will consider B Limited as minority interest. Okay. Now, because B holds more than 20% but less than 50% in C Limited, so therefore what will happen? C will become associate of C Limited. Sorry, B Limited. C will become associate of B Limited. Now, in this situation, what will happen? In this situation, B, which was required to prepare its standalone financial statements, will additionally be required to prepare its CFS. Yes, you heard it right. Some of you who may be not very clear on this, B will also be required to prepare CFS. In the CFS, what will B do? B will combine two parties. Which two companies? B and its associate. So A will not come into picture in relation to this. It will be B and C Limited. B and C Limited. And what will be the basis of consolidation? So that is something we'll discuss as we move further. Okay, so that is something we'll discuss. I understand Sapna has a query. Yes, Sapna, please go ahead. Yes, Sapna, please tell me what's the question. Please go ahead. No question? All right, so now, because B is required to prepare the consolidated financial statements, so that's why B will follow some methodology for the consolidation. Okay, that methodology is different from what is required to be considered in case of a subsidiary. Fine. Now, coming back to the point that we were just trying to discuss, that is in the context of significant influence. Now, what do you mean by significant influence? Significant influence means that the investor, okay, in this case, investor will be having a right to participate in the decision making of C Limited. Now, if you look at C Limited, okay, C Limited is a company. C Limited will be taking a lot of decisions. Some of the decisions will be key decisions, means important matters will be discussed. Now, there is one party who will drive all of those decision making. Drive means who will have the final say. Why? Because it's the one who holds majority shares, which has got majority voting power. So tomorrow, if any decision is required to be taken, so who will have the final say? It will be A Limited. Okay, so A will be the driver. But if you look at B, so will B be the driver for the decision making? No. But B will always be able to participate in the decision making. B will be able to participate in the decision making. Okay, so that right of participation is what you call as significant influence. Clear? Yeah? All right. So I understand Harleen has a query. Yes, Harleen? Please go ahead with your query. Yes, what's the question? No? All right. So maybe you can just write down your query. All right. Okay. So now let's look at some small examples in relation to this associate only. So let me just go to the study material. So just give me a minute. Let me just go to that material. All right. So let's look at this example. A Limited has 70% holding in C. And B Limited also has 28% holding in same company. Okay, so let me just try to put this information in the form of a chart. So A has 70% in C. Okay, and B has 28%. So A Limited with the majority holding, that is more than 50% in the parent company, will be what? So this will be the holding company. If you look at it from the perspective of C, C will be the subsidiary. Correct? Since B holds more than 20% shares, but less than 50, therefore, what will happen? What will happen? C, for the purposes of B, will be an associate. So this will be considered to be an associate company. Okay? Yeah, so this will be considered to be an associate. Fine? All right, so let's look at one more example. A Limited is holding 90% shares in B Limited. So let's look at this. So if you look at B, A is holding 90% shares in B. Okay, and 10% shares in C. So there's one more company in which A holds 10% shares. Sorry. Okay, so there's one more company in which it holds. So this is C. Okay, so it holds 10% in C. Fine. B is holding 11% shares in C. So if you look at B, so B is holding 11% in C. Okay. In this case, if you look at A and B, so these are clearly parent and subsidiary. Okay. As far as A and B are concerned, I understand there's some technical glitch. Bhargav? Bhargav? I can see your messages. Bhargav, you're there? Bhargav, you're there? Yeah, so should I wait for some time? I just received your messages. No, so I'm just asking you, should I wait? No, so there's a message, kindly leave and rejoin. There's some technical problem. So I'm just waiting up. Please tell me what should I do? Bhargav, should I leave and rejoin? Okay, just a minute. Okay, I'll rejoin then. Huh? Let me know. I've rejoined whenever to restart. Okay, all fine now? All right, I'll just quickly repeat this example. I'm not sure as to where did we lose. Okay, so we have a situation wherein there are two companies, A, B, A and B are holding and subsidiary. Now A also holds 10% shares in C. So A also holds 10% shares in C. In C, B also holds 11% shares. Okay. Now, as far as relationship between A and C is concerned, we discussed A Limited has a total of direct and indirect holding in C Limited. So now, if you evaluate the relationship between A and C, A has a direct holding of 10% and indirect means which is routed through B. Why over B, A has control. Therefore, all in all, if you look at it from A's perspective, this will be considered to be 21%. This will be considered to be 21%. And the moment we say it's 21%, what will happen? C will become associate for A. But can we say the same thing for B? No. Why? Because B has got only 11% in C, whether direct or indirect. Okay. So therefore, we cannot say that C will also become associate of B. So that will not be appropriate. That will not be appropriate. Yeah. Okay. So I think this is it. What you had on the understanding of the associates. There's further more onto this as far as its accounting and other aspects are concerned. But I understand there's some technical glitch. So I have been advised. So we need to end this session now. Yeah, correct, Bhargav? We need to end this session now. There's some technical problem. Yeah, so we'll just. So do I need to continue now, or after leave should I rejoin, or we need to end this? Bhargav, we need to close the session, or shall I rejoin? No, I'm asking you, Bhargav. मतलब अब खत्म करना है या फिर rejoin करना है? No, I'm getting this message from. See, I'm getting this message, Bhargav. Are you able to read the messages? Okay, no worries. Okay, sure. So I'll just leave the session. So thanks everyone for your time and for your participation. Thanks so much.